how the Federal Reserve's tapering and interest rate hikes could potentially affect asset prices in the U.S. So let's dive right in. We're going to talk about QE and tapering and what the Fed is talking about doing. And they're also talking about raising interest rates, and we're going to go over how that interest rate, the interest rate and the principal relationship in your loan, for example, for your home loan or for your car loan. So starting with the tapering, or QE, QE is nothing more than quantitative easing. Quantitative easing, they're talking about tapering it from $120 billion per month to $70 billion per month. Now what this is the Federal Reserve has pledged to buy $120 billion per month in mortgage-backed securities, equities, and treasuries. And now they're saying they're going to cut back on that spending. They initially tapered to $105 billion. Now they're coming on down to $70 billion. But what happens when the Fed actually does QE? Well, your dealer banks go to auction and they buy these treasuries and mortgage-backed securities. Well, the Fed comes in and goes, okay, we got to buy $120 billion of these a month, or now we're tapered to $70 billion. So what the Fed does is they come in with these bank reserves and and they swap them for the treasuries and mortgage-backed securities. Now all this is an asset swap. For a dealer bank, or for the banks, in general, a mortgage-backed security, a treasury, and a bank reserve, and there's more than that, but these are examples of assets that they can hold on their balance sheets to where they can make more loans in they can make loans in the real economy, and they can actually loan out cash against these assets. So the Federal Reserve comes in and goes, okay, we'll buy these treasuries and we'll buy these, but what the Federal Reserve gives the banks in exchange for their mortgage-backed securities and treasuries are bank reserves. So that's what QE actually is, and what they're saying is they're going to buy $120 or $70 billion per month now from these dealer banks that bought these at auction. The Federal Reserve is going to buy from them, and that's all that's happening. Is this asset goes from here to here, and the liability on the Fed's balance sheet goes from the bank reserves or liabilities, and they go from the Fed's balance sheet over to the asset side of the dealer bank's balance sheets. So now we've got our mind wrapped around QE, and we have to understand that in order for the Federal Reserve to raise their interest rates, and they've come out and they said they're going to raise interest rates 3 times next year. How much they're going to raise them, not seen a report on how many basis points they're talking about raising them each time, but considering the U.S. debt, our sovereign debt, is actually financed on short terms, we roll it over anywhere from 2 weeks to 6 months to a year, 2 years. We rarely ever finance anything on a 30-year note anymore. So every few weeks this debt has to be rolled over and refinanced. So it gets refinanced. If we've got $1 trillion that comes due in 2 weeks, and say for instance now it's on a 1% interest rate, and the Fed comes in and raises that interest rate, we'll just take it to its logical conclusion to a normalized rate of 5 or 6%. Now that $1 trillion that we had previously had financed for 1%, we're now financing for 5 or 6%. So, and that's just an example of what they're doing, what they're talking about doing. Now they're talking about raising these rates 3 times in 2022. They're talking about doing this to help combat the inflation. They're talking about the CPI keeps going up and up and up, and they're talking about doing this to combat it and get the CPI back down to a normalized rate where they want it around 2%. They're saying it's getting a little too hot. We're going to have to pull it back down. So in other words, they've got their money. They think they've got too much loose money in the system, and they're going to try to pull it back in a little bit. Now, how does this affect asset prices? So far, we've just went over QE, and we've went over the treasuries and and the bond market, and that's where they buy the treasuries and things, is in the bond market at the auctions. But how does this affect asset prices? How does this affect car loans and home loans? How does this affect your credit card loans? Well, your bank loans are generally based on the 10-year treasury. So if the Federal Reserve comes in here and they jack up that interest rate on that 10-year treasury, all the bank loans that are being issued will be issued at a higher interest rate. So let's tie this into the market. Let's say you want to buy a house. Now you have to understand an interest rate is the price of money. And money is 1/2 of every transaction in the economy. So for instance, you want to buy a house. You go down to the bank and the bank will say, okay, we can issue you this loan at say 6%, but we can issue you $150,000 at 6% interest, and that's about what we can do today. All right. Well, the Fed comes in and they raise rates, the 10-year treasury goes up, and let's just take it to its logical conclusion. Let's say they jack them up like they did in 1981, where the Federal Reserve raised the overnight rate to 18% to try to break the back of inflation. Okay, well right now we're anchored down around 0, 1.5, 1.7. Say they jack that rate all the way to 18%. Well, you go out and you hunt you a house. You say, well, I've got $150,000 I can spend on this house. So let's go see what we can find. So you go down to your local real estate agent. They take you out there and they show you everything they've got. You pick you out a house. You go back down to your banker. You go, okay, we had this loan set at 6% for $150,000. The banker goes, oh, whoa, wait a minute. The Federal Reserve come in about 2 weeks ago and raised this rate. We're going to have to redo this. There's no way we can write you a loan for 6% now. That loan's going to have to be at 15%. Well, how does this actually affect how much house you can buy? When your mortgage, or any loan for that matter, your payment is based off of your principal amount and your interest amount. So when your principal, you get your statement, it'll show you how much you paid that month in principal and how much of your payment went to interest. Well, let's take this example here. Say we've got a $60 payment. And for instance, we decide to go out and we buy the amount of house that a $60 payment will buy at a 2% interest rate. And for instance, that interest rate is $10 a month. Okay. The Fed comes in, they jack their interest rates up. So now, where we were spending $50 a month on principal, now we can only spend $40. So where you were approved for a higher loan value, say before you were approved at $150,000, now because you can only pay back so much in principal, and you're having to pay double or even triple or more back in interest, now the amount of house that you can actually afford, because most people buy their houses based on the payment. You know, they go down to the bank and they say, okay, well, here's what I can afford a month on a payment. What kind of loan can I get? How much can I borrow? And the banker sits back and he does it. He figures it all out with his interest rates and his principal amounts. This is approximately how much house you can buy. So what's the real estate market going to do when the Federal Reserve starts raising rates and people can't afford to pay as much for their houses as they was due to the cost of money, the interest rate actually going up? Well, what this does is these houses don't get sold. If they're listed for, say they were listed for $150,000, $175,000, $200,000, well, now nobody can get that amount of money because the interest rate, which, mind you, is the cost of the money, which is 1/2 of the transaction, has went up, has skyrocketed, and now the buyers can only afford to buy a $100,000 house Well, then what you get is all these houses go unsold. When they go unsold, there's more supply. So eventually when supply gets to be so much and people decide they've got to sell their houses, the real estate the market starts to come down, and they start lessening the value of the houses so they can move them. That's basic supply and demand. As long as there's plenty of demand and plenty of money flowing around and people can afford to borrow the money at the interest rate to pay $200,000 for the house, well, that's just exactly what the market wants. They want you to they want to get as much as they can out of it. What's this house worth? What's this car worth? Well, that's when you go to the market. That is a price signal. But when the interest rate goes up and the borrowers can't borrow that amount of money, then the sellers have to come off of that price and sell them at a cheaper rate, because now where they was going, well, this is the only house we can afford. Well, now we got 30 or 40 houses to choose from that we can afford, because there's more supply on the market driving the prices down. So you see, as the Fed comes in and starts messing with interest rates, they're not just saying, okay, well, this is something that's between us, between banks, between the big banks, and what they're doing is messing with the price of money. And when you fix the price of money, money is 1/2 of every transaction in the whole economy. It affects everything. So buckle your seatbelts and get ready. I believe we're going to be in for a little bit of a ride here as everything comes crashing down.